Hey everyone, it's Gia Silva here with NT Realty, and today I have a great treat for you. We are interviewing Lisa Halayan. She is a wealth advisor with Newport Advisory, and today we are going to be discussing Delaware Statutory Trust. Now, Lisa, thank you so much for joining us today. And I know that you have over 30 years of experience and you're servicing a lot of areas here in California, so I'm really excited to have you on.
Thank you, Gia. I'm so excited to be here as well.
Well, Lisa, let's get right into it. You know, our clients are apartment owners. Anytime they're looking to sell a property, they're always, thinking about, okay, what's going to happen with taxes now, those capital gains. And then a lot of them who have owned properties for a very long time are also considering not having to manage anymore and having all those landlord duties. And so we came across Delaware Statutory Trust, and let's get right into it. So Lisa, what is a Delaware Statutory Trust? Who is this a great option for, and why is it a great option?
Sure. Well, a Delaware Statutory Trust is basically a trust that is really investing in real estate. It affords the investor all of the wonderful attributes of investing in real estate, but it's passive investing rather than active. So it alleviates all of the issues that real estate owners are faced with, especially tenants, toilets, trash, termites, etc.
Right.
Is a diversified portfolio. So you have the ability to invest in more than one property, usually several within the portfolio. It offers the tax advantages as well for capital gains taxes, and it provides income. It also provides you with the depreciation, but the day-to-day management is something that is handled for you by the actual affiliate and a very experienced investor that manages the trust and takes care of the day-to-day operations of it. So this is an ideal vehicle for investors that want to have all of those great benefits that real estate offers. If they've owned their property for quite some time in the state of California, where this is an appreciation state, in all likelihood, they've exhausted their depreciation, 27 and a half years worth. In addition to that, the tax rates here in California stand to be anywhere between 35 to 40% of the capital gains. So that's a pretty high rate, and most investors want to avoid paying those capital gains, and the DST allows them to defer any taxation on that.
Okay, so that's a really great vehicle. Now, you mentioned that they could still be investing in real estate. What type of real estate properties could they invest in?
Sure, it's a great question. So basically, these trusts focus on, and really the portfolios are focused on properties that are outside of the state of California for a lot of obvious reasons. I mentioned that this is an appreciation state, and so the cap rates are going to tend to be a lot lower, meaning the income is going to be a lot lower that investors would receive. So the trust focus on properties primarily within the Sun Belt, and it is diversified, and it's in various sectors, which include anywhere from multi-family housing, it includes storage, it includes healthcare, and it does avoid retail. So obviously there are obvious reasons for that. And so in most portfolios, there can be anywhere from 3 to up to 9 different properties within that portfolio, and all diversified.
All different areas, all different states.
Sure. So typically you're going to find Arizona, you're going to see Texas, you're going to see representation in Florida, and basically just across that Sun Belt here in the U.S.
Okay, great. Wow. And what about in terms of how DSTs work in a 1031 exchange process? How do they work?
Sure. So, I think every investor that is looking to do a 1031 exchange should consider using a DST, whether or not it is going to be the primary investment, as a default. It is a replacement property or portfolio, I should say. And so it's a safety feature that comes along with the DST, because you have a 45-day window of when you have to identify the properties, and you can do the 3-property rule, or you can do a percentage, the 200% rule. In any event, oftentimes a lot of investors that are looking to do an exchange have a failed exchange because the properties either went through escrow beforehand and they didn't know about that.
Yeah.
If they just locate a property, sometimes it's not their ideal property, but it's just because they have that 45-day window, which is the hardest window to really achieve. Then you have 180 days by which the entire transaction has to be completed. When you identify the DST, it stops the clock, so to speak. And it also is that safety cushion. It's a protection that you have so that if a property gets sold out from underneath you, you still have the DST in place. And so therefore you're going to be able to still continue with a 1031 exchange using the DST as the replacement property.
Got it. Oh, it does. It does absolutely serve as a cushion.
Sure. It doesn't mean you have to go through with the DST, but at least you have it there. So it's that added protection that you have.
Exactly. It's better to have it and not need it than need it and not have it. Absolutely.
That's right.
Awesome. Okay. And what about the type of initial investment needed, the rate of return, and then most importantly, what is the holding period also?
Yeah. So typically the minimum investment is $100,000. And basically some people will use this for the boot, which is whatever the remaining amount is left over. You want to protect that from taxes as well. So typically an exchange, 1031 exchange is dollar for dollar. So minus closing costs. Dollar for dollar, and oftentimes if you buy a property that is valued lower than what you sold, then you're going to have what we call boot, so the remaining portion, and that is still going to be taxed. So you want to use a DST. You can use that for 100,000, 150,000, whatever the case may be. In the case of using the DST in its entirety for your exchange, then whatever that would be, dollar for dollar. The yields, so we call it mailbox cash, and the portfolios provide monthly income, and it can be anywhere from about 5 to 6.5%.
Okay.
So it's relatively much higher than here in the state of California. And then there's capital appreciation, and typically the holding period is anywhere from 5 to 7 years.
Okay.
Lately, we've had a lot of private equity and a lot of pension plans that are in the need for real estate properties, and they're buying some of these portfolios sooner. So you might see, especially healthcare, oftentimes they're selling within 2.5 to 3 years, and then investors will just roll it into the next DST portfolios. But with that, you have very attractive total return numbers. So once these portfolios are sold, and all the properties have to be sold at the same time so that they can pay all of the investors at the same time. So those are very attractive yields and returns.
Nice. So again, investment, $100,000, right?
That's the minimum, correct?
That's the minimum.
Right.
Return, you're looking anywhere between 5, 6.5%.
That's monthly income, sure.
Monthly income.
And you're going to have any capital appreciation when they sell these properties. And typically they've been doing very, very well. They've never had a cash call. They've never had a negative year, and they've never lost money. One of the sponsors that I tend to default to has had a 52-year track record. They've done 150 what we call round trips from start to finish. And probably the maximum holding period would be up to 10 years, but we really don't see many of these portfolios being held that long.
Got it. Yeah. So you're saying maybe up to 7 years, but they could be. That's the longest.
Sure. Yeah. There's a lot of demand today for real estate in general, especially these types of properties that have been managed appropriately. They're well located and developed properties. So they're in hot pursuit, hot demand.
Absolutely. Absolutely. And Lisa, with so many companies out there and so many options, what are the most important factors when an apartment owner, a real estate investor is looking for a company to go ahead and do a DSTs with?
Sure. So I think a track record is really, really key. One of the largest companies that our firm has on our platform. So I would just first start by saying that our compliance department has approved various companies, sponsor companies, and those are the ones that we use. Sometimes we'll divide up if it's a very large value, then we'll get further diversification and use more than one sponsor. But it's important to know that all the compliance and the background, the due diligence has been done on all of these companies, on the properties. The private placement memoranda is a very thick book, and one is written for every single portfolio. But that's key, and you want to have the diversification. But I think with a 52-year track record, the results that they've delivered in 150 round trips is really important.
Absolutely.
You want the name, right. Yeah, you have to be careful with some that are syndicated by small companies. You want to make sure that there's liquidity liquidity and proper management, a lot of different factors that go into it.
Yeah, well, definitely a proven track record for that many years is is very important. Absolutely. And lastly, can this be used as a estate planning tool as well?
Well, most certainly. This is an ideal estate planning tool for a couple of reasons. The most important part is that when the owner passes on, it actually transfers to the heirs and it goes at the stepped up cost basis. A couple of other ways that we've seen it used is that oftentimes when there's heirs that might be spendthrifts or have issues where they just cannot handle managing the assets themselves, this provides a proven vehicle. It has proper management, the experience is there, the know-how, and they don't have to worry about dealing with the day-to-day management of the asset or assets. But again, with the spendthrifts, this is a great way to have something already in place and you don't have to worry about that.
Yes.
The other thing you can do is, let's say the heir wants to liquidate and pay the taxes. It's at the stepped up cost basis, so that's not going to be an issue as well. So there's liquidity as well.
Right, and it avoids that, that conversation that needs to happen between heirs at times.
That's exactly right. Yes.
Yeah.
Very simple.
Well, you know what? This absolutely sounds like an amazing vehicle, a really great option for apartment owners who, again, don't want those landlord duties anymore and are looking to sell their multifamily properties or investment property. Lisa, thank you so much. That was such great information. I am going to include all of your information. So if any one of our clients is interested to learn more about Delaware Statutory Trust, please contact Lisa, contact myself, and we would love to have a strategy session with you. Thank you so much, Lisa.
Thank you very much, Gia. Take care.
You too.